Good afternoon, everyone. I'm Pamela Hastings, Relationship Manager at Barometer Capital, and welcome to another Tuesday afternoon webinar with David Burrows, our Chief Investment Strategist and President at Barometer. On today's webcast, we will provide you with a brief macro overview. And of course, at the tail end of this conversation, we're always happy to address your questions. So don't be shy. Please email me at phastings@barometercapital.ca or send us a question via the chat on Zoom. Thanks so much. And with that, I turn the conversation over to David Burrows. Good afternoon, David.
Hi, Pam. How are you?
Great. Thank you so much. How are you?
Great. Thank you. Glad everybody can join us today. We got a bunch of stuff to work through for a day in the middle of summer. Lots to look at. And so maybe we'll just sort of kick right off. Over the last few weeks, markets have been kind of chopping sideways. In some of the groups, technology has been stronger leading up to the last couple of weeks. And so we just want to examine some of the messages from the market. As always, just starting from the top, we believe that the US stock market started a structural bull market in 2013 as we exceeded the highs from 2000's bull market, much like the market kicking off the bull market in 1981 after exceeding the highs from 1966 market peak. And during a structural bull market, there will be lots of reasons to worry. There's going to be lots of pullbacks along the way, but certainly it's more like 4 steps forward and 1 step back than what happens in a structural bear market, which is more like 1 step back, 1 step forward, 1 step back, 1 step forward, which ultimately winds up frustrating investors into leaving and going to other asset classes. We've been making a case that we've been going through a structural bottoming process in long-term interest rates in the US. They've been in structural decline since the early 1980s, and similar to the early 1950s when they were going through a bottoming process, which took 5 to 6 years to complete. And I would make the case that we started this process in 2016. It does take time, but ultimately what works in rising rates or reflationary environment is really quite different than what works in falling rates. And so it takes a significant retooling of investor expectations and portfolios, frankly, to set up to take advantage of it. Also, from a structural perspective, we think we went through a structural bottoming in commodity prices last year. Been out of favor for a very long time. And once they get into gear, it can go on for a long time. So important to understand the structural backdrop that we're working against so that we can understand consolidations and corrections as opposed to bear markets and be prepared to take advantage of them. In the S&P, we've been in a pretty clear channel since last fall. We went through a little correction September and October. And then the election came and it was off to the races. And really, we've had a very consistent market ever since. I think confounding lots of investors who have a hard time understanding how it is the S&P did quite so well during a global pandemic. But we know there's a couple of things that contribute to asset prices. Certainly one of them is liquidity. And there's just been a ton of liquidity pushed into this market. But also there are some very resilient industries in the US, some world-beating companies. And the S&P has really led the world. When we take a look at the NASDAQ also has been in a pretty clear channel. We did consolidate from March through the beginning of June. And then after some time, market turned higher. The large cap growth stocks really performing well. And frankly, going through the earnings period, very few investors want to be sellers leading into earnings. Most of the large cap tech stocks did report very strong earnings. Amazon did disappoint investors and the stock dropped 7%. The fact that the NASDAQ 100 has held in as well as it did with the largest company in the NASDAQ dropping 7%, quite interesting. Now, the TSX, similar to some of the reflationary themes, has been consolidating from the beginning of June, but certainly over the last couple of weeks, a little bit better. If we take the equally weighted S&P 500, this tells a bigger story because this is the average stock, the behavior of the average stock in the S&P. And we know that the S&P equally weighted index really underperformed through late summer and fall last year, but once ultimately it broke out of that range, it really powered its way higher, leading the S&P until it started to correct in the beginning of May. So now we've had 86 days where the S&P equal weight index was in a range. And this is the chart that I put up 2 weeks ago in the last webcast, saying that this was going to be an important tell. Is it consolidation, which is time, or does it turn into something more? So when we look at it today, here we are 2 weeks later, the equally weighted S&P is coming out of this consolidation range to the upside, roughly 100 days in the making, which likely points us to a situation more like what happened last fall in October, November, and will likely confound a lot of investors who have looked at the seasonality and say, I'm afraid of the market in July, August, and September, and has shaken out a lot of investors. So let's take a look at the NYSE Composite Index. This is all of the companies that trade on the NYSE, less weighted to the largest cap stocks. Similarly, same kind of consolidation range, now threatening to break out to the upside. So these are certainly important things to have happen in the market, because markets do need to correct. They do need to either correct in price or in time. We've seen some time consideration. Let's take a look through some of our indicators. When we put this up on July the 20th, we mentioned that many or virtually all of our short-term indicators had been backing off. So the percentage of stocks in the NYSE that were trading above their 50-day moving average had moved from 80% down to just below 20%. Same thing for the Canadian market, and something similar going on globally. Also, the percentage of stocks with positive momentum had moved down into the 30% range. And the percent of stocks trading above their 150-day moving average or very long-term moving average had moved down to below 50%. So here we are 2 weeks later. What does it look like? Well, certainly there's been lots of improvement. Percent of stocks trading above the 50-day moving average has moved up from 22% to back above 50%. If we take a look at the NYSE percentage of stocks with positive weekly momentum, it's moved higher. Percent of stocks making new highs versus new lows, and percent of stocks making 150-day move, also trading above the 150-day moving average, moving back higher. If we take all stocks, this is just on the cusp of reversing higher. If we take the NYSE bullish percent, or percent of stocks in the NYSE trading with long-term positive trends, it flipped back higher last Thursday. So at this point, all of our long-term and short-term indicators are back with the wind at our back. And certainly we're seeing re-acceleration, and we're going to just examine that a little bit. So let's talk through some leadership themes. When we were on last, we mentioned that after a very significant run-up from the beginning of March to early May for the materials sector, if we took the S&P materials companies, the biggest cap, they were down on average 6.8%, which in fact was really not much of a give up, considering the fact that lots of people wanted to point to the fact that a new wave of COVID could mean that the economic recovery gets postponed. If we looked inside the Russell 1000, industrials were down 11.5% off the highs. Financials were 13% off the highs. Consumer discretionary 14% off the highs, and materials off 15% from the highs. Again, what would be typical normal correction if that's where it stopped. If we took the S&P materials sector and looked at the percent of stocks trading at a 3-month low, 57% of stocks were trading at a 3-month low, consistent with corrections in a bull market, inconsistent with a bear market. If we take the financial sector, percent of stocks trading at a 3-month low, 51% of stocks, consistent with corrections, not so much with bear markets. It looked to us like we might be going through a bottoming process. So let's take a look at some of the key leadership themes. This is the long-term chart of the equally weighted Rogers Commodity Index we highlighted late last fall. that we were coming out of a downtrend that we've been in since 2008, 13 years. These are monthly bars. So we started working our way higher and we were coming into this moving average, causing some consolidation. If we take a look at that picture today, over the last 2 weeks, we've seen a reacceleration, a taking out of these highs. Again, similar to the equally weighted S&P, similar to the NYSE index, completion index, taking out the top end of the range. Consolidation, 80 days, what would be typically normal. So let's look at a few groups. Forgetting the commodities themselves, let's look at the stocks that produce the commodities, because we like to see the stocks lead the metal. After consolidating from early May in a range, we touched the long-term moving average, reversed higher, and broke out of that, what we'll call a bull flag. This is a consolidation pattern, and prices have broken out back above, reaccelerating. This is the mining ETF, PICK, which would include the base metals and the precious metals, consolidating from early May, breaking out, retesting, and working their way higher. This is the long-term picture, and this is what's really important. When we break out of a bear market, in this case, for the miners going back to 2013, it is very common after breaking out and making a new high to pull back into the breakout point. This shakes out investors who believe maybe this run is over, but a month, 2 months later, we pull back, hold, rally, and move higher. That's the end of this little consolidation. If we take Rio Tinto as one of the global leaders in the mining group, after consolidating since 2011, we broke out, pulled back, rallied, pulled back, and now breaking out of that flag. So this is common across many of the companies in the commodity sectors, and this is consistent with a consolidation. And the reason that this is so important to understand this is when we take a bigger picture view of what happens when you come out of a bear market. The last time Rio Tinto came out of a commodities bear market in 2004, stock was up 493% between 2004 and 2008, 4 years. Wouldn't we all love to see returns like that? So having come out of this bear market that we've been in since 2011, this is the very beginning. It's been retested and consistent with lots of other commodity stocks like BHP and Freeport-McMoRan look very similar. This is the steel subsector, the ETF SLX, consolidation in a bull flag, down to the moving averages, reversing up and out. This is the agriculture equities. This would be the chemical companies like the fertilizer companies and the suppliers into agriculture like the heavy equipment guys, AGCO and Deere, again, breaking out of this range to the upside. You're going to see a lot of commonalities here. This is the forest products group. We all read about the collapse in lumber prices. Basically pulled it right back into the long-term consolidation range and reverses higher. Let's talk about gold. I keep getting asked about gold because, of course, after a very long bear market, gold's had a wonderful run 2018, 19, 20, and actually consolidated over 11 months, broke out, retested, and now moving higher. So all of these reflationary sectors seem to be performing quite well. When we look at materials relative to consumer staples, after consolidating, have reversed back higher again. When we look at a material sector, again, percent of stock trading above the 200-day moving average, we certainly corrected down just above 60% above the 200-day moving average, now back at 93% of companies in the group trading above the long-term moving average. Clearly the uptrend continues to be in place. Now, part of this has to do with the fact that the US dollar since early May, after being very weak from the beginning of the bull market in stocks, rallied back and tested the previous high. There are many investors who thought perhaps US dollar was making a turn. We did say in the last conference call, likely we were running into resistance on the US dollar. A weakening US dollar is investors being prepared to take risks, selling a safe haven asset and taking it, buying an asset that may give a better return than a dollar adjusted, an inflation adjusted dollar. So reflationary assets. Now let's look at a few things also that might be driving these companies. This is the ISM manufacturing inventories data. This goes back to 2011. I think this is a stunning number. Inventories in the system are at a low, almost of a factor of 2 relative to the longer term average. So this represents obviously some bottlenecks in the transportation and shipping industry, but it also represents the fact that there are very low inventories. They're going to have to be restocked over the next number of weeks and months. Probably good for industrial goods and basic materials. Let's take a look outside the US, things that also investors might buy if they think there is a global recovery taking place. After consolidating from the beginning of June, the India 50 broke out of this flag to the upside, now taking out, as of today, the highs. If we take the Mexican market, big supplier to the US economy, again, after a long bear market, broke out, retested, and has turned back higher. Even the European Union equities, after breaking out of a long bear market, bull flag broke out to the upside. So I think there's a fairly consistent message here. Emerging markets, very similar. And again, after a very long bear market in emerging market equities, broke out, retested this breakout earlier on. This is going back to early winter and now taking out highs. Let's look at some of the sectors within the US market that also are tied heavily to the economy and perhaps a lack of inventory. After consolidating in the auto industry, a breakout to the upside. If we take consumer discretionary, after consolidating from early May, a breakout to the upside and a retest. Consumer discretionary versus consumer staples company, economically sensitive versus economically insensitive, equally weighted, taking out the impact of the largest, most heavily weighted companies, obviously Amazon being one, is now back at a relative high versus the consumer discretionary group. Moving into financials, after consolidating from early June, this is the investment banks and broker dealers broken out of the bull flag range. And the same thing for KBE, which is the large banks, again, pulling back into the point from which they broke out, going all the way back to 2008. And into technology, the most economically sensitive group within the technology sector are the semiconductors. We watch semiconductors like we watch copper. And again, after a huge run from middle of winter until recently consolidating and then turning back higher. So I think that it's pretty clear that the reflationary themes, after taking a much needed breather, look to be reaccelerating. Now, there's AMD, which is one of the leaders in the semiconductor group, long consolidation and a very sharp acceleration higher. Look at the volume that's come in so far in the last 5 days in advanced micro devices. Last point I want to make is we've talked in May about the MTUM ETF. This is an ETF made up of companies that have positive price momentum, upward trajectory versus the market. This was dominated by technology companies coming into May. It gets rebalanced on a quarterly basis. It's done doing a quantitative calculation to take all of the companies in the market with the best price momentum. And after that group, which were all reflationary assets, consolidated over a period of weeks, the MTUM ETF is now breaking out of that range to the upside, again, signaling reacceleration of this reflationary theme. Things that I would like to see join this rally. The industrial sector as a whole has been consolidating for 89 days, has not broken out of the range yet, but I would highlight that the last time the industrials consolidated between November and February, it was 87 days. And then we went on this rampant run through until spring of this year. IWM, which is the Russell 2000, a broad-based ETF of 2,000, actually just shy of 2,000 companies, again, has been consolidating 141 days, is yet to break out. That's something that we're going to watch closely. But I will say that the bullish percent readings for that universe have shown an improvement from 40% of companies within the Russell 2000 being in an uptrend to today 58%. So improving by 18% over the last 2 weeks. So these are all market-based indicators. At Barometer, we believe it's not about what the market should do, it's about what the market is doing. And through the course of consolidation, most of our stocks held in remarkably well. They did certainly correct. We certainly did give a little bit back, but having seen that they held their long-term uptrends and re-accelerating to the upside, it looks to us like reflation is certainly back on. Let's just look at some important data that came out over the course of the week. Most recent employment, initial jobless claims continue to be pretty consistent. This is important because we remain elevated well above the levels pre-pandemic. The Fed's made it clear they don't plan to do anything that could derail this recovery until we get back to more normalized unemployment claims. But the most important thing to look at now is earnings. We're right in the middle of earnings season. And so far, when we look at 296 companies out of the S&P 500 having reported, the average company is reporting sales growth year over year of 27%. Now, clearly sales was low a year ago. Earnings up 100% year over year. But more importantly, when we look at versus expectations, the average company has beaten the revenue expectation by just about 5%, which is consistent with an improving market. We also have seen companies beat the earnings estimate by roughly 18%. Now, what I take away from this is actually something different. This is the way that companies have behaved after reporting. And you can see that after beating the estimates, most sectors are showing share prices going higher post earnings, meaning that the sum total of the expectations weren't in excess of what the companies reported. So we're getting positive market behavior coming out of the companies that have reported. Now, I'm proud of the fact when we look at the companies that we own, which is of course a subset of these, from our companies on average, they beat this, they had sales growth of 39% and earnings growth of 104, well above what the S&P had. And from a sales surprise standpoint, 6% sales surprise and earnings surprise of 24%. And again, importantly, strong price movements after earnings being reported. So this is 32 of our 44 US stocks. Now, let me just talk about seasonality for a moment. If you think about it, when we have often seen weakness in the third quarter between June and September and October, generally it's been August and September. If you think about it from a sentiment standpoint, when an analyst comes into a new year with an expectation for earnings, when you get 2/3 of the way through the year or into August and September, you start to know whether in fact your companies are going to meet the estimates, exceed the estimates, or miss the estimates. Very often, by the time you get to the third quarter, you're realizing the companies are not going to make the estimates. And so you start to see estimate revisions lower. In many cases, this has caused uncertainty and weakness in the stock market in August, September, and October. As we come into this second quarter, we expected July the 1st, 45% earnings growth. As of the 30th, it's 50% earnings growth. So analysts taking their estimates higher. Looking at third quarter numbers on July the 1st, the estimate was for $47, and the estimate as of July 30th is $49. So estimates are moving higher. So when we look at the things that drive price, certainly earnings are very important, but really it's the change in expectations that is most important. Are estimates going higher because analysts have been too conservative, or are they going lower because they've been too optimistic? Very clearly right now, we see analysts taking their numbers higher, meaning they have been too conservative. Second thing is liquidity. Will there be continued liquidity in the market? Well, the employment data points to the fact the Fed still has a green light to continue to be easy with policy. That's monetary policy. Fiscal policy. Well, we're on the cusp of seeing something come by way of an infrastructure deal. And timing on it is still uncertain. The amount is still uncertain, but that poses possible increased liquidity in the market. So we're seeing buying across asset classes. And then when we look at the breadth readings that we have continue to point to an improving, strong bull market. There's financial conditions, the easiest on record. When we look at credit risk, if people are concerned about a third wave, credit markets are not. The spreads that bond investors are demanding to get compensated for the credit risk attached to a corporate bond, credit spreads are at record lows. Here's a little closer look as of this week. So when people get concerned with risk, the spread that they demand to take the risk expands. We're not seeing any of that. And when we look at volatility, we have had several spikes in volatility since the first spike in the spring of last year, but each successive spike has been to a lower high. And again, midway through July, we had a small spike in volatility, but again, right back into this normalized range. When we're in this pink area is when you get the best returns in equity markets. So for all of those reasons, and because of the fact that our process is all about focusing on leadership, we have three basic beliefs. One, focus only in areas of market leadership. We don't need to be in every sector. Watch very closely for change. For instance, are defensive sectors starting to outperform economically sensitive? Right now, the answer is no. Coming into this, economically sensitive stocks were leading the market from November until May, and after consolidating, look like they are reaccelerating. And if in fact our data pointed to a deteriorating market, we're very willing to use our stop losses, raise cash, and avoid those parts of the market. It is a very tactical approach. As we sit today, after correcting many of the leadership groups from early May into the middle of June, we've seen a reacceleration in GDX, that's the gold producers, basic materials producers, consumer discretionary, miners, equally weighted S&P, investment banks and asset managers, Mexico and emerging markets. So here's where we sit. As of this week, financials weight versus a month ago, 25% of the portfolio, 2.5 times the market's weight. Energy's at 17% versus market weight of 3. Technology is an underweight at 15% versus 27% for the S&P. Industrials at 7.5%. Consumer staples remain a small part. Materials are double the market weight. Bonds, communication services, utilities, consumer discretionary, relatively small weights, and healthcare. These are the more defensive groups. In our macro portfolio, we are leaning into the reflation trade. As you can see, precious metals, financials, emerging market equities, materials, you can read the numbers. Look, we're very happy to play defense when the time comes. It's hard for investors in a structural bull market because bull markets that are in long-term secular bull markets can go a lot further than you think they can. The S&P broke out in 2013, it's 2021, that's 14 years. Sorry, that's 8 years, typically 15 to 18 years for a structural bull market. NASDAQ broke out of its bear market in 2016. We're only 5 years in. TSX, frankly, only just broke out of its bear market a year ago. So we've got a long way to go, we think. We're very happy to get defensive if need be, but right now we're going to follow the numbers. If our models change, we'll change the portfolios. But I think that there's a long way that investors will have to go to reposition from the largest of large cap tech stocks and defensive stocks that they built weightings in over the last several years during falling rates into this reflationary theme, and we're relatively early stages. With that, Pamela, if there are any questions, certainly happy to answer.
Thanks so much, Dave. We just have one question this afternoon, and that question comes from Stephen in Toronto. David, some of the big tech stocks the Barometer owns crushed estimates early this week. No real reaction, or I guess last week, because we missed last week's call. No real reaction to beating revenues by billions of dollars, not just millions. What should ordinary investors like Stephen take from the response to these results? And more importantly, the limited reaction.
Sure. So look, there's a reason why we have less than half the market's weight in technology, because frankly, they're well owned, they're wonderful companies, but expectations are very high and sentiment has been really forward positive. Okay. So it's not to say they aren't great businesses, and there's not to say there isn't opportunity to outperform. But there are other sectors that are far less owned, that we are double and triple market weight, where we think there is much more upside to earnings expectations, and where the share prices are performing well coming out of the reporting period. So I don't want to avoid some of the best companies in the world, and we certainly have weights, but this is not where we're staking our claim. We're staking our claim in reflationary themes that are tied to the real economy in sectors that have been out of favor for years. When I show those long consolidations that materials have been in, or the long consolidation that financials or industrials have been in, when we look at the long multi-year periods where global markets have been out of favor, like Taiwan, 20 years, Japan, 30 years, these are groups that are in the very early stages of a bull market. We think that you don't want to miss that opportunity.
Thanks so much, Dave. Actually, one other question just slid through here. If you have an opinion on the KWEB Chinese Internet ETF.
Yeah, great question. Now let's see if I can switch over here. Pam, can you see charts on the screen?
Yes, I can, Dave.
Okay. So as many people have read, the Chinese government are really cracking down on some of their leading companies and the fact that they trade actively in foreign markets. And so one of the issues is whether they're good companies or not, this has really scared North American investors. So there's the KWEB. It pulled back into support, but on these recent government actions, seen a considerable pullback. Now, same with the ASHR, which is the China 50 index, not to the same extent because it's less about the biggest heavyweights, but certainly also have pulled back into long-term support. Let's make this a little bit bigger. So this takes us back to 2015 levels. So there are political risks. The reality is the Chinese equity overall ETF probably isn't so bad. They are very inexpensive relative to US companies. The problem is, as we're seeing, there isn't the same rule of law or respect for capital markets. So that's shaken out of a lot of investors. I know in the case of our macro fund, last week when ASHR had its bad day, we stopped our way out. And so we have very little exposure, if any, to those companies within the KWEB. We did own it in the macro portfolio, but we got stopped out prior to this drop. Let's just take a look. we got stopped out back in here in the middle of July. So I think that they're going to have to do some work before we see them reverse, even with some discussion around the Chinese wanting to have conversations with the US over market regulation. The share prices are not really responding. So I think that the market's going to need a little bit of reassurance. We're going to need to see some healing technically before we can revisit these companies.
Thanks so much, Dave. Well, that concludes our questions for this afternoon after a beautiful long weekend. Dave, I will leave you with the final word. And as always, we're grateful for your time. Thanks so much.
Well, listen, we certainly appreciate everybody logging in. Sometimes markets go quiet for a while, and we need to see them get through consolidations and improve. And I guess that my takeaway is as simple as this. This is the equally weighted S&P. This is as of the close. We had a strong close today, coming out of that range nicely. We never know what's going to happen next, but there's a lot of clues. And I think we saw a lot of clues today that the economically sensitive sectors are reaccelerating, and the back half of the year is likely to be very good. So as things change, we'll change the portfolios. But as it is right now, I think we're positioned well and in the right spots. Thanks so much for everybody for joining us today.
Thank you, Dave.